Welcome. In this video, we'll explore how credit sales and credit card transactions impact businesses, both operationally and from an accounting perspective. Before I started teaching accounting classes, I worked in public accounting, but spent most of my career in industry. I worked for small, medium, and large companies, and regardless of the size of the business, credit sales, credit policies, and whether to accept credit cards are important decisions. In this video, you'll learn to distinguish different types of credit sales and credit card transactions and how accountants record them. What are credit sales? Credit sales are when a business sells a product or service to the customer today, but doesn't expect payment until later. In most businesses, net 30-day payment terms are common, but some businesses also offer discounts for earlier payment, such as a 1% discount if the customer pays within 10 days of the invoice. Can the business afford to essentially finance the sale for the customer at no extra cost for the customer and potentially risk non-payment? That is something the business must consider. In addition, does the business have the resources to pursue collections of past due invoices? That's another consideration. So credit sales are made with the expectation that the customer pays later, timely. The sale is recorded by the accountant on the day of the sale as an accounts receivable, meaning debit accounts receivable and credit sales revenue. Now, it's important, though, to distinguish credit sales from credit card transactions. In the case of the credit card transaction, the customer pays immediately with a credit card, and the business must wait a few days to receive a payment less the merchant credit card fee. So a credit card sale is often a cash sale, with some exceptions I'll talk about later in this video. The advantages of credit sales are increased sales volume. The customers may buy more if they don't have to pay immediately. It may also increase customer loyalty, and offering credit can strengthen relationships with customers. In addition, if competitors offer credit, doing the same helps the business remain competitive. On the other hand, if the competition doesn't offer credit sales, then the business may have a competitive advantage by offering payment terms. There are disadvantages as well. First, there is the delayed cash inflow. Money isn't received immediately, which can strain working capital. Does the business have enough cash to finance the sale? In addition, some customers may never pay, requiring the accountant to set up an allowance for doubtful accounts or record write-offs. And there is the administrative burden of monitoring receivables and collecting payments. The companies I worked for had various approaches. Some had a very strict credit policy, like when I worked for a company that created t-shirt designs that customers used to press onto garments. The cost for a customer to enter the industry was not very high, and that meant that many people also quit quickly. So the business I worked for required prepayment for most orders until we had at least 6 to 12 months experience with a customer. And then the customers had to fill out an application, and we checked their references and their financials. On the other hand, I worked for a software company where most customers were immediately approved for credit. There was no credit policy, but somewhat surprisingly, there were hardly any non-payments. Perhaps that approach would have changed if there were many non-payments. And speaking of credit policy, balance is the key. A credit policy that is tight might lower the risk, but could potentially also lower sales. When the credit policy is loose, there are more sales, but also a higher risk. I have found that there is no one-size-fits-all approach to managing credit for a business. The business might have a unique advantage in the marketplace that encourages customers to pay promptly because they don't want to risk not being able to buy from the company again. On the other hand, if there are a lot of players in the industry, customers may order without any intent of paying because they can simply switch to another vendor. So the takeaway is know your business, understand the industry and your customers, evaluate creditworthiness, set limits, and enforce collections. I already mentioned that credit card sales are really cash sales from the business's perspective, but there is one exception. Let's talk about that first. If the company has its own credit card and is managing the credit card on their own, not through a third-party bank, then that is also considered a credit sale. This type of situation is rare these days, and most store-branded cards are managed by a third party. Now let's talk about the credit cards like Visa, MasterCard, and bank-issued cards. The advantage is the near immediate cash minus the fee. There's a lower default risk because the credit card processing company assumes the risk, and customers appreciate being able to pay with a credit card. The disadvantage for credit card sales is the fee, which can range from 1% to 4% and can be higher for online sales, as well as chargebacks when customers dispute charges. The accounting transaction for cash credit card sales is debit cash, debit credit card expense, credit sales revenue. In my experience, though, many companies don't use the cash account for the debit, but rather a temporary holding account to allow the accountant to cleanly reconcile just the credit card transactions. So debit an account like credit card collection, credit sales revenue. Then when the money from the credit card processor is deposited into the bank account automatically, it would be recorded as debit cash, debit credit card fee, credit to credit card sales collection account. Credit card activity can be very messy in my experience, especially when the company accepts Visa, MasterCard, American Express, and Discover Card for both online shop and sales team activity. The amounts from the same day's sales are deposited on different days into the company's bank account, and the accountant may have to closely analyze what credit card payments from what day have been received and which haven't. This is an important account to keep a close eye on. Let's practice on a few examples from our textbook. In this transaction, the business sold merchandise on account to Osaki Company, issued sales slip 1200 for $2,015, terms net 30. We record this transaction by debiting accounts receivable or Osaki Company and crediting sales for $2,015. When the payment is received 25 days later, we debit cash and credit accounts receivable or Osaki Company for $2,015. Here's an example for a credit card transaction on February 2nd. The company sold merchandise totaling $2,300 plus tax to customers using bank credit cards. Record the 5% discount on credit card sales at time of sale. We debit the credit card expense for $124.20, which represents 5% of $2,484. We debit cash for $2,359.80 and credit sales for $2,300 and credit sales tax payable for $184. I hope this video helped you understand credit sales, the advantages and disadvantages, why credit policies are important, and how credit sales are different from credit card sales.